Everybody hear me okay? All right. Okay, and away we go. I think I got my screen sharing working now as well too. See if everybody can. You all see my screen? Not yet. Okay. Well, again, apologize. We're having a little bit of a difficulty here with the screen sharing stuff, but if it comes back up, we'll be ready to go. So um, we're going to head on out. We're going to get rolling here. Everybody hear me okay? Okay, all right. Well, let's go ahead and get rolling here. So I'll try to fix it when we move along here. So thank you everyone for joining in with me this afternoon. Um, my name is Bob Lang, and I run explosiveoptions.net along with the chat room and Spread Trader. Happy to have you guys all aboard here today, and I do these webinars every Thursday afternoon. Sometimes I do them solo alone, and sometimes I have a really great, wonderful, and powerful guest. In that case, I have that today with Miss Jill Malandrino, who was a former colleague of mine over at thestreet.com, Real Money and Options Profits. She's moved on and has been just doing some amazing work currently now with the NASDAQ. I encourage all of you guys to follow her on Twitter. I think she'll tell us no, but I think she's like Just Jill 04 or something like that. You can find her though on Twitter. She's a good follow. She puts a lot of good information out there. Very good friend of mine, and we'll talk with her in just a couple of minutes about markets and stuff, and kind of more of a macro view of things, not so much individual issues. But Jill's always got some great insights about things, about markets, and about trends that you guys all need to listen to. So I think my screen's up now, right? For some reason I'm not getting. The screen's a little bit too big. All right. So again, thank you for everyone for joining in with me today. What I will do is hit the record. Again, I hit the record button and let you know that if you can't make it for the whole entire session today, don't sweat it. We'll have the recording up a little bit later on this afternoon, or if not tomorrow morning. I'm going to be heading out about 3 o'clock my time because Christopher and I are going to be going to see the Kings opening night against the Flyers at the Staples Center tonight. We're really going to be exciting. Really pumped up. I'm looking forward to that. And I promise to have a report for everybody, even if you're not a Kings fan, tomorrow. We'll let you know how it went. So should be a lot of fun. So if you can't make it all the way through the webinar, it'll be up there a little bit later on. If you have any questions for myself or for Jill while we're doing the webinar, just go ahead and type it in there. And again, if you have any technical difficulties similar to what I've had here this afternoon, what you want to do is go ahead and close out of the webinar and come back in. That should probably take care of any issues. So, all right. I'm just going to be real quick and give you a little bit of overview of the markets here for right now. And it's been an amazing run here for the last 8-9 days. Look at those green candles for the past actually 7 days. 1, 2, 3, 4, 5, 6, 7. Up every single day. New all-time highs for the past 5. Up over 2,500 on the close for the past 5 days, and we're at 25.52. We're probably at some targets of some strategists out there for the entire year, and we're only in October. So we got another 3 more months, just under 3 months left to go before the end of the year, and it's quite possible the markets run up, right, a little ahead of itself. We see that happen. Stocks run to the upside a little bit too far. They run to the downside too far, and all we're trying to do is capture something in the middle there. We are pretty overbought at this point in time. Could we expect a little bit of a pullback? Absolutely. And we it's certainly probably going to happen, or maybe even stall a little bit. The VIX is down close to 9. It's about 9.19. We've had record amount of days in 2017 with the VIX down low where it is. I'm going to give you my my opinion as to why market volatility is low here. And Jill and I just talked about it a couple of minutes ago. It kind of makes a lot of sense about why there has been such a lack of selling. And I'll give you I talked about it on Tuesday while we were at the in Chicago. So we'll talk a little bit about it in a few minutes. But volatility is down. Markets are up right now, and we're heading into earnings season. So this is a time that it's very difficult to have a short position here. Look at these last 7 months or so. This goes back to March, right? And look at these past 7 months or so. It's just, every dip is being bought. Higher highs, higher lows. And you don't have to be a brain surgeon to figure that one out, right? I mean, price action, we talk about price action all the time. It's so important. And you don't have to be a brain surgeon to figure out that higher highs and higher lows is a bull market, right? I mean, you can fight it all you want and lose money all you want. Nobody gets a prize for losing the most amount of money, right? I mean, so you can fight the trend as much as you want. Jill and I know some people who do this for a living on a regular basis, and unless they have some kind of endless flow of money coming to them and their clients and so forth. If you want to fight the trend, be my guest, but you're just going to get pounded day after day after day. All right. And, I don't know about you, but I prefer my pain delivered in different ways, different formats. But other people have their choices. So S&P 500 up new all-time highs. I think the RUT hit a new high today. Dow Industrials new all-time highs as well too, nearing 23,000, the round number over here. So again, volatility is really, really low. Protection is cheap. It's always good to have some protection on. We always have some protection on here as well too. But don't fight the trend is really the mantra right now, the name of the game. So I'm going to bring in Jill right now, and So Jill Malandrino is with us today, and Jill, you can see her in the background. So Jill is a wonderful writer, strategist. She's an interviewer. She's done lots of different things in markets. Whip smart and knows what she's talking about. She knows options like the back of her hand. She's a veteran. She's been in the wars. She's been through the good, she's been through the bad, and there's nobody that I think is better at understanding markets and trading than Jill. And she ran a great product at TheStreet.com for quite a long time called Options Profits. She took it; it was fledgling. It was about ready to expire, and she took that product and launched it into a really sound product for real money and for the street, and they made a lot of money with the product. Unfortunately, sadly, they went away, but Jill was responsible for that success for that product. So I know Jill. I've known Jill for a long time. She's a winner and everything that she does, and I know she's doing well at the NASDAQ. But anyway, Jill, you there?
I am here.
Great to have you here, Jill, and say hello to everybody.
Hi, it's great to be back with you guys again. Thanks, as always, for having me on.
Always. So Jill, let's kind of jump right into it. So any of the action here for the markets, the last couple of weeks, maybe the last couple of months, anything surprise you at all?
You know what? I feel like nothing surprises anybody anymore, but I will have to say that I'm really, I don't know if the right word is impressed, but the resiliency in the market is quite remarkable right now, considering that there is a lot of uncertainty in the marketplace right now. And as divisive as things have been, it really is impressive to continue to see this market action. But I want to bring up something that I did learn in my travels. So in addition to watching the market all day, what I do over at NASDAQ is I cover different conferences from the retail investor level to all the way up to institutional asset managers. And we were in Washington, D.C. with the show for the Security Traders Association conference in D.C. They have an annual market structure conference. So it's a little bit higher level what I'm getting into, but it's applicable for what's going on for us as options traders. And with everything that was spoken about at this market structure conference, I wouldn't say everything was negative, but there was a lot of pressure that the buy and sell side are facing due to regulatory implementation that has to happen for 2018 and just some overhanging structural issues in the market. But the one panel that was overwhelmingly positive was the options panel, and they were represented by a big bank, the OCC, a liquidity provider, in other words, a market maker, and someone else on the compliance side. And as complex as the listed options market are, and the fact that we're operating in a very low volatility environment, volume is actually growing. In the month of August, we saw it up 3%. That one day that we had that volatility spike,
Yep.
volumes were up 20%. We actually, I think it was September 25th or 26th, on one of the lowest vol days in history, we had the highest volume in the VIX. So basically, the overriding theme here was there's fabulous infrastructure in place once we do get these vol spikes again, and they're confident in risk management controls. And what's great about this is the confidence in the options market suggests that there's going to be even more product to come for traders to use in their plans. And that to me was overwhelmingly positive. I've out of all the different asset classes that I cover, this has been the most positive that I've heard in quite some time. So the fact that we're seeing volumes grow in such a depressed fall environment, I think is overwhelmingly positive for the options trader and investor by far.
You know, we had Mark Sebastian with us on Tuesday. He came to the SIBO to visit with our group, Jill, and he talked about still, even with volatility as low as it is, he's seeing just tremendous opportunities, not just trading volatility in the markets, but, you know, up and down volatility. He mostly trades volatility, but he's been seeing quite a few opportunities in trading options elsewhere too. So I think it kind of validates what you mentioned as well too, right?
It absolutely validates it, and I can tell you from the exchange perspective and some higher level market structure conversations, they are looking at it to make it more fair when it even comes to small and mid cap trading names, where you just don't have this, you know, fabulous liquidity in the top 30 to 50 names, but they're looking at different ways to broaden that out and really introduce better trading, if you will, for that reason. And I think that it just goes to show how the exchanges and other leadership are seeing just how important options are to every type of investor. Another big area that we're making a significant push in is with a registered investment advisor, but financial analysts. Even they are the fastest growing segment using options within their portfolio, and there's a number of reasons. One, the market has made such a run; they're looking for ways to protect those gains, and rightfully so, and looking to derive income in an environment where it just doesn't exist. So I think we're going to continue to see that options growth, and I think we're going to continue to see a slew of product introduced, which is great for all of us that are trading it.
With the options market so brisk right now, what are people, what do you hear people are doing? I mean obviously the one trade that's been solid in 2017 has been selling vol and selling premium,
right,
that sort of thing. So are we hearing a lot of people doing that? We have the spread trader product, obviously, that it's been really successful this year. Is that something that you're hearing people are doing? Are they selling premium? Are they buying, going long, or what? What are you hearing?
You know what, the thing is, it's really interesting. I was on a podcast last week, and one of the traders that I was on with it was joking around. He's like, oh yeah, I could take an hour off from the market because I'm short vol. And he was saying it in jest, but you're starting to hear, you know, the risk clearly is to the downside, because seriously, how much lower can it go? So you're starting to hear people not necessarily selling it outright, but starting to put more spreads on. That is one trend that I've been noticing. And again, it's not just with retail investors, day or swing traders that are kind of scratching their heads in terms of what to do with this, but even asset managers that we meet at these conferences, they're asking the same questions too. whether you're putting on a short or long-term position, these metrics count for everybody. And I also think another conversation that I'm starting to have a lot more now is using options to day trade. And that is something that I have not heard in the media, or I have not heard that conversation on the retail side as much as I've heard this year.
Well, I do have to tell you, it really makes the hair on the back of my neck go up when I hear you say that people they're short vol and they're just they're taking the rest of the day off or something like that. No, normally, when you sell premium, yes, you do have to kind of wait it out until the end so you can take all that in. But with volatility, of course, being such a things move so so fluidly, so dynamically, for somebody to take that kind of complacent attitude. I mean, that's, maybe back in the day when I was a wildcat trader back in the late 90s, when I didn't care if I lost a lot of money or made a lot of money in a particular day, I might have had that attitude. That really, I mean, maybe I'm just old now, Jill. I'm 50. I mean, am I just old and I'm just old school now and I just I'm crotchety here or
No, not at all. But you know what though, I will say that sometimes I will go back and I will read posts that you have in your blog, or even just go through my Gmail and look at the conversations that you and I have, because the one thing I love about working with you and with your service is you have always been one of the ones to preach, trade what the tape gives you. Yep. And to go where the momentum is. And that's the way it's been. I will never, and we had this conversation in the last webinar that we did a few months ago. I remember when I was on February 11th with you, and that was the market low. And look at where, February 11th, 2016, and that was the market low.
That's right.
Right? I remember what I was wearing that day, and you had said, you know what, regardless of what we think fundamentally, what charts might be suggesting, the trend is a trend till it's not anymore. And literally, if we could call that the Bob Jill bottom, then so be it. But I think we have to apply that same mantra to where we are today, because this has been a really ugly rally to try and fight. And I just don't really know what else to say when it comes to that.
So what's your view about if we just kind of interject a little politics in here? I don't want to talk about politics here, but obviously there are some policies out there that are going to affect the stock market and stock prices. And I'm actually pointing into one direction right now, and that would be tax cuts or tax reform or so from something.
Right.
Like that.
And it's so interesting because when I remember, I did a couple hits at MarketSite about this earlier in the year, and I thought that if we were to see any vol, it would certainly be within the first 100 days of Trump's presidency, because you have to start to see some of these campaign promises at least go into practice. And regardless of what side of the aisle you were on, for all intents and purposes, it's been a giant fail. There has been no legislation that's gone through. And my concern is that we've seen the market run 20 to 25%. A lot of it is based on tax reform and getting healthcare work through. And at some point, I don't know if it's this quarter or the next quarter or two, but these earnings are going to have to translate into this run that we've seen into stocks. And we're coming into 2018. It's the midterm elections. These kinds of things are going to get pushed to the back burner. And then, even though Trump seems to be campaigning every day, they are actually going to come into campaign season. So it's like I said at the beginning of the webinar, I am, like I said, I don't know if impressed is the right word, but the action that we've seen in the market is quite remarkable how resilient it has been.
So from a valuation standpoint, I've heard people mention that, oh, well, we're way overpriced here, way overbought. No, I mean, not just overbought, but way overpriced over here, that it's not sustainable and so forth. And they're comparing this to the bubble days back in 98, 99, early 2000. And frankly, I mean, I can understand. Listen, you know what? It's always been my notion that anybody who identifies the bubble is the person who's not involved, Anybody?
Right. Well, I don't think I would compare this at all.
No, I agree.
To the bubble in 2001. It is a completely different market.
Yep.
It is a completely different basket of stocks that we're looking at. To be honest with you, people that are calling, let's say, social media stocks, for example, they're out of bubble and so forth. They didn't even exist in 98, 99, 2000. So that argument is invalid there. And I just think that companies are more lean, they're more compliant, they're more regulated,
Hmm.
and the market itself, the structure of the market itself is different than the bubble in 2000. So comparing them is almost apples to oranges in my mind.
Absolutely true. So as we you mentioned earnings. So this coming week, we'll have I guess next week is kind of the sort of the start of Q3 earnings next week. What are you looking for? I mean, I think some people are looking for 9-10%. I talked to Lindsay a while ago,
Mm-hmm.
and Lindsay Bell's great, and I know you know her. So she
Yep.
said that we talked in Jill in July back in front of earnings season, and she's one of the few who called it correct, and you did as well too, about how strong earnings were going to be in the second quarter, and they were going to lead into probably to the end of the year. She said there might be a little bit of a stumble in Q4 because their numbers were too high. But what's your feel on earnings for this coming quarter starting next week?
I happen to agree with Lindsay, and I love her research as well. And I think that the third quarter, it'll continue on the trends that we've seen for the first and second quarters, with technology again leading the way. And Lindsay and her team have been right in terms of what happened with the energy sector, and I think that you'll continue to see some rotation into that as well, because it just has been so beaten down. And I think that oil has, it's going to be in $45 to $55 range, and if companies can perform within that range, and they have been, I think that you could potentially see some rotation into there. I also think it's going to be interesting to watch the retail sector this quarter and next couple of quarters to sort of see where the outliers shake out. um, Particularly with the department stores. Are we going to start to see some of them go private? Are we going to start to see further consolidation in that space? Clearly have the Amazon effect. I still love the discounters like Ross and TJ, as you know, that I've spoken about a number of times,
Hmm.
that's just the way the consumer shops now. They either want it online, they want to get that satisfaction of getting a deal at the discounters. And the thing is, I speak to retail experts from women's wear daily, and a number of other industry resources, and it all comes down to either having the perfect online presence or providing that perfect experience within the store. And that's why you're seeing the decline in areas like the department store. So I think it's really, it's the energy, tech, and retail sector's game to win it at this point.
Jill, we had Stacy Widlitz on the webinar with us a couple of months
Oh,
ago.
oh,
Stacy's fabulous.
cool.
There's nobody better when it comes to talking retail
Absolutely.
than her. And she gave a real dour look for retail, and and really Amazon at the time was the main culprit for issues and problems with these with logistics for some of these retailers, and they're stuck in like a time warp. She said
Hmm.
they're not into the 21st century. They're completely backwards and slow to respond. I mean, companies like Zara
Yeah.
who can change things in a couple of weeks. So I think the whole landscape there is changing, and there's going to be winners, there's going to be losers. I think there's going to be far more losers than winners. I think Amazon is, I mean, I looked at the announcement today. I mean, they came out and said today that they were going to start up their own delivery service, and look who got hammered today. It was FedEx and UPS. I mean,
Hmm.
they were down a lot more earlier, but I mean, these shots across the bow by Amazon. Let's just stick with the retail there. I mean, they've been devastating, damaging for a lot of these companies. I mean, look at Kroger. I mean, that's
Hmm.
I mean, it's enormous. Lots and lots of stores are a shell of their former self now, and I think that's something to pay attention to. Now, we've always been fond of the fertilizer names, right? And for the longest time, and it seems like they've been asleep for a while. And I guess they're lacking some pricing power. There's also some competition coming from China as well too. But anything in that area that interests you, or
You know,
even
it,
not there, but just
it's
maybe in commodities.
it's so funny. I honestly have not looked at them as closely up until a couple of weeks ago, because I was like, you
Really?
know what, we have. I just haven't been paying attention to them as much as we did a few years ago, because the story there is kind of, not I don't say died, but it's kind of not in the news cycle at this point. But
Hmm.
I think if you were to look at anything in the commodity space. I think the story is going to continue to be oil. I think, looking at the metals, that's going to be interesting as well, because again, with so much imbalance on the more macro level, we haven't seen a significant move to one side or the other. I also think the currency trades are going to continue to be interesting, which is why I think earnings, especially for your larger international conglomerates, will be something to take note of, particularly as we see how currency has impacted the balance sheet. So, for example, like your GEs, your Honeywells, that really do depend on currency fluctuation. Look how low the dollar has been. So I think that's kind of what I'm paying attention to right now. There's a lot going on geopolitically that's kind of coming to a head. There's a lot that's going on with the central banks that's coming to a head, particularly as we start to unwind balance sheets and so forth, starting with us. And I think that's really what the trade is going to be, or are the currency trades, or at least to get some clues looking forward in terms of more macro and policy.
So going into the end of the year, though, we talked a little bit about this. I've come across some statistics that seem to be quite favorable for markets to finish out the year. I think Stephanie Link had put something up a couple of weeks ago that said after the first 9 months, if they're positive, I think it was like an 80% chance that the markets would finish much higher by the end of the year. Also, Jeff Hirsch from the stats, but he put out there said that the worst 6 months of the year deal were what. Early May to the end of October, right? Sell in May and go away, and then everybody's supposed to pile in right before Thanksgiving, right after Halloween. And he said that when that's up 5%, he said it's like some crazy 90% of the time the markets will finish up in the next 6 months. And he said 1 6-month period, Jill, was up like 28% from November to the end of April, following a strong worst 6 months of the year. So it's interesting. I think there's a lot going for this market in terms, statistically, but also from a technical basis too. Is there anything not to like about this market?
Well, it's really interesting. I follow Ryan Dietrich. He's a great follow on Twitter, and awesome. He's the senior market strategist over at LPL, and every day he just pumps out where he finds his stats. I have no idea, but he if we want to get a little political and a little historical at the same time, he actually put something out on Monday, and like a lot of people, he mentions that if you would have forecasted the 11 months after this particular election would have been the least volatile periods of the year, you would be in the minority, right? And then he points this out, that the last time we saw a streak of calm like we're in right now was actually after JFK was assassinated in November 1963. So that goes back to prove that the market really does what the masses expect and usually does surprise us. And that's really what the narrative has been for all of 2016. So it's kind of counterintuitive. Everyone's sort of like, okay, well, we kind of expect the rest of the year to do well because that has been the trend. And I feel like when everyone piles into that trade, the market kind of always does what the masses don't expect. So it'll be interesting to watch for sure. And then, look at the end of the year in December, we'll have the Fed rate hike decision coming up. But I think even more than that, once we start to get clues into how this is going to be unwound, if things remain the same, I think that could be a potential catalyst to see some vol come back into the market, because that's gonna be a big piece to getting back to normal, if you will.
So we've always talked about the importance of having some protection on, and certainly with the VIX down at 9, I defy you to find any other time historically where volatility has been this cheap, and it's been cheap to buy puts. Do you this is certainly not a time you want to be all in. I know there's a lot of people out there who they do that, and they get their head handed to them after all.
Yeah, well, a lot of people have been all in short since, I don't know, the past 7 years ago, and look how well that's worked out. So anytime anyone says all in anything, right, run the other way. That makes it makes me absolutely insane to hear that. Yeah. But I think that it's almost like the car insurance comparison that we use all the time. Look at the gains that people have made in their portfolios. Look at the long positions they have on now. How could you not put on a VIX position, at least for some protection? You could call it the VIX tax, as Mike affectionately calls it. I just don't see how how you couldn't, even if you were to put some spreads on to kind of mitigate some of the risk within your VIX position. But I don't know. I can't imagine not having something on right now. And of course, it doesn't just have to be the VIX. You can also look at, you depending on what sector your portfolio is weighted to. For example, if you have, let's say, more tech stocks on, like, NASDAQ listed big tech stocks like Amazon's, Apple's, Microsoft's, and so forth, use the Qs or the NDX to hedge. Everyone thinks that the VIX is the only hedge, but it's only specific to the S&P 500. So I think when you look at your portfolio, you have to really decide where your allocations are and then pick the appropriate hedging tool.
I think that is about as smart as of advice that that anybody could ask for. And something, I mean, for instance, looking at the you said about the spreads. I mean, I mean, the SPY finished at about 234 and change or something like. You could buy like a 230 or 230 to 230. Is that right? 230? Is it 230, 230 put spread for probably less than $1, and to cover yourself for a just in case some volatility comes in. If we rock down 1 or 2%, those things that's at least going to protect you. And if it doesn't happen, you still got your long positions. And like I love Jill's term, the VIX tax. If you're not doing that, you're gonna be whacked around left and right. Look what happened back in August on August 10th and August 17th. I'm sorry, the SPY was 250, not 230. But look what happened back in August 10th and August 17th, right? And we know the markets reacted to what August 10th was, President Trump's comments about, well, fire and fury, right? Remember that? And then on the 17th, it reacted to his weird comments about what happened after the Charlottesville, Virginia riots were happening. So, markets tend to react to that sort of stuff before you even know it, and it won't give you any particular warning. But having that protection in place is always very, very helpful, just in case, right?
Yeah, well, what scares me more, and again, I don't want this to get too political, but he says such outrageous stuff every day that my concern is the market just doesn't even react to anything anymore. And even with, there's a different shooting event, mass shooting every day that I don't know if we're so predisposed to it because of social media and we see things instantaneously now and we have more exposure to it globally, but my biggest concern is that the market just doesn't flinch to anything. Like, if you were to hear a mass shooting thing on the overnight, because it happened, when was it? It was Sunday into Monday, were the futures even open yet?
It was Sunday into Monday. Yeah, I mean, the market has gotten numb.
Oh my
right?
God. Yeah. It did absolutely nothing. If that would have been even 5-10 years ago. Do you remember like when Hurricane Katrina came through and what happened to the oil futures? Like, it would make such a big deal. Nothing flinches anymore. And that's kind of what scares me. If we're not flinching on this kind of news that's rolled through, oh my gosh, how much more can we take over the past month? Mm-hmm. What's going to have to happen for it to react?
It's the conditioning. I think it's the conditioning.
Exactly.
Jill. And that complacency kind of scares me because I mean that's the sort of thing that gets people in trouble. And again, harken back to the protection. If you can, there's not a lot of people out there who are doing that. So, I mean, I always try to tell people to be different, do something a little bit different than everybody else does. If nobody out there is buying any protection, even if it's cheap or not, why not do it anyway? You're contrarian, be right. A little bit different than everybody else. But we discussed earlier about possibly some of the reasons why volatility is staying low, and I touched upon it on Tuesday. Again, I think with what Warren Buffett said the other day. This guy is not selling anything until he sees some resolution with the tax cuts or tax reforms and so forth. He said over his career, 50 plus years in his career, he's rarely seen a something like that be a catalyst for him to do something or to do nothing in his portfolio. But I found that interesting because, I suspect there's a lot of hedge fund managers out there just like him who are doing nothing right now until they see something happen. So, now, when you think about it, you step back a little bit, it makes a lot of sense that why volatility is so low.
Well, I mean, you just said it right there. There's just no sellers in the market.
Mm-hmm. No sellers. That's right.
I mean, I feel like we've said that. I don't know. I don't feel like I've ever said I've never seen anything like this. I truly have never seen anything like this. And it feels like there's almost a vacuum right now. There's no sellers out there. There's no buyers. If anything, it's sector rotation. But I mean, look, we just creep up on zero volume. It's really just the S&Ps that are virtually moving, right?
Mm-hmm.
I can't remember ever seeing anything in a vacuum like that. Again, going back to January and February 2016, I remember there were days where we were just like, gosh, how much more selling can possibly happen?
Right.
And it was only about a couple of months, and I think it was warranted. We needed to take a step back, but we haven't stopped moving higher since. And it really feels like the past 2 or 3 weeks where, I mean, you'll even wake up in the morning and the futures are either literally at zero or they're a point in either direction, in either one way or the other, suggesting nobody knows what to do. And I feel like, I don't know if I would say I feel like it's coming to a head one way or the other, but yeah, it's very interesting to watch right now.
How about if you don't mind, we talk a little bit about a couple of tech names. I know you got to go in a couple of minutes over here, but I don't know about you, Jill, but I'm waiting for that iPhone X10 to come out, and it seems like everybody I've spoken with who's got an iPhone is ready to upgrade. They're going to go with that one, and they're not going with the 8 here. So it tells me that it seems like there's a lot of pent up demand here. That even though Apple has been beaten up here recently, I think it was around 7% or something like that. It's up a little bit today. It seems to me that this might be a good spot for Apple, especially going into the holidays. What do you think?
Yeah, Apple's interesting because I feel like there's a lot of focus that's put on the hardware itself, and that they're quietly doing software things behind the scenes. Mm-hmm. And there's a lot of cash in that company. They could virtually buy anything that they want, and I wouldn't kick Apple while it's down should the 8 cycle not be quite what people had expected. And I just kind of remind myself of that when I take a look at it. I mean, from a fundamental perspective, it's really hard to hate the stock. The balance sheet is crystal clean. Look at all the cash that it has. It's really hard to hate it. In terms of me being compelled to get an 8, no, because I'm cheap. And I will use my phone until it doesn't work anymore or until I drop it in the toilet bowl again. But I think you just can't isolate Apple and look at it from a hardware perspective solely.
That's funny because we were at Howes and Hood for dinner the other night, Jill, on Monday night, and I went to the bathroom and some guy was I was just washing my hands and some guy was in there standing in front of the urinal and he was on his phone and all of a sudden, boop, there it goes, right.
Oh my gosh. I've done it like 3 times because I put my phone in my back pocket and I always forget, but in any event. So yeah, I've been good for, I think, about a year and 3 months now. So unless, and then I have Apple Care anyway, but yes, I just wouldn't look at Apple solely as an iPhone company.
So let's kind of wrap up one more thing. I have one more topic to talk with you about financials and interest rates and so forth. It's been my notion that the banks were they let them out of they let the horses out of the barn, Jill, a little bit earlier this year when the regulators came out and said that they could they took the harness off of them and they could go out and do a ton of buybacks and pay dividends because they're sitting on a ton of cash. So they just basically let them loose. And I've been telling everybody for months, buy any dips in the banks and they're going to stay bid all year long. And certainly, some of these stocks have hit multi-year highs. I know Bank of America, $26 and so forth. Citigroup is up quite a bit, and JP Morgan's almost at or near all-time highs. What's your view on that? I mean, these banks, are they going to stay bid the rest of the year, even though the yield curve is not as steep as they would like it to be able to create that net interest margin?
Yeah, see, that's what concerns me there, because you would think intuitively that rates are going to move higher, and therefore net interest margins would improve. But like other stocks, I'm concerned that they've went ahead of themselves. What happens if we don't get this rate hike in December? We kind of saw a little bit of that pressure when we didn't get one over the summer.
Hmm.
What happened with the banks? But at the end of the day, they're as well capitalized as they ever have been. I know there's horrible optics out of Wells Fargo right now, but if you look at your bigger ones, your cities, your banks, your Bank of America, your JP Morgans, and so forth, even stripping out trading revenue, they're as lean and as capitalized as they've ever been. So banks, it's a sector that I struggle with because I think those are one of the ones that have had so much of a run up based on reforms, based on rates going higher. I could be wrong. They're always going to be attractive as dividends continue to get paid. But that's a sector that I have a hard time with because I feel like the run is predicated on things that haven't happened yet.
Mm.
So what do you think about that? I mean,
Well, well,
I'm not negative, but I'm not sure how I feel plowing into them.
well, I think the again the horse is already out of the barn, and a lot of these stocks have really taken off to the Morgan Stanley, Goldman Sachs. I mean, some of these stocks have gone up quite significantly. Good, some of them 10, 15% just in the past few weeks. So they're probably a little bit overheated right now. But again, in Citigroup is up quite a bit on near $76. So people are piling into these things, and there's been some big volume. There's been some big money coming in. We always talk about where's the money coming from. This isn't high frequency traders. This isn't algorithmic traders. This is big institutional money, pension funds, hedge funds, mutual funds, charitable trusts, banks, foreign banks, and so forth. This is the big money. This is what moves markets, and they're piling into these things. So I have to believe that the protocol there of buy any dips is still the action that needs to happen probably into the end of the year.
I would agree with that.
And then how about Fed policy? What do you think? I know the market is expecting a rate hike. I've been on record as saying I don't think they're gonna hike in 12. And my reasoning for that is because I think they're suffering from Fed delusion and Fed confusion right now. I think there's some of them out there who don't think that they need to raise interest rates because inflation is low, and they've actually come out last week, Jill, and admitted we don't understand why inflation is so low.
Right.
And so go ahead.
There's a lot of uncertainty with the Fed right now because we could potentially be having a chairperson change as well. So that's certainly going to be an overhang. I don't know. I don't know if raising hikes is a bit premature. Again, we're at historically low levels. I mean, are 25 bips really going to move the needle that much? I think the bigger concern is how they're going to unwind QE, because and the thing is, when Janet Yellen was speaking a couple of weeks ago, she had said that the biggest uncertainty really does lie with how we are going to unwind the balance sheet, and nobody knows, and that's why I feel like things are kind of like in a vacuum right now, because there's lack of clarity in terms of what direction different asset classes are going to go, even though we continue to close higher day after day. So I don't know if it's necessarily rate hikes that are the issue. I do think it will make a big difference in terms of who gets nominated to take over the chair seat, because they're clearly going to have a dovish or hawkish perspective. I would imagine the president has full control in terms of appointing someone. I would imagine he would go with someone who favors lower interest rates, tends to be more business friendly. So I would say that's the big wild card, and of course the unwinding process. I think the market can absorb a rate hike, but the unwinding and the chairperson overhang is kind of where the uncertainty is.
I think that unwinding, Jill, is going to be so slow. It's going to be so boring. Everybody's going to sit through the whole thing.
I hope so. I hope it is orderly.
Well, the one thing I think the Fed learned is to do the best they can, even if they're uncertain about things, do the best they can to create less volatility. And when they shocked when they would shock with words about, when Bernanke said, well, we may taper, and all of a sudden we had taper tantruming and all that other stuff going on. When at the end of the day, when everybody was belly aching, complaining, oh, this is just a Fed-induced market, a Fed-induced rally because of all the buying. Well, look, hello, they stopped doing it 2 years ago, 3 years ago, and they haven't been, juicing the markets. They hold a lot of bonds, but they haven't been juicing the market up that much. So a lot of false premises and so forth. But people are going to believe what they want to believe, and it's all about the narrative, I guess, right?
Well, it's all about the narrative, but it really matters what your P&L looks like at the end of the day. Price action is really going to trump that. So
that's exactly right.
I don't want to sound flippant, but that's kind of what we're staring at. And this is what we're dealing with right now. It's not a market that is comparable to the bubble in 2000. It's not comparable to what we had 5-10 years ago. It's different in terms of market structure. It's different in terms of the types of companies that are leading the market right now. So it's just different. Markets evolve, and I realize that this is unprecedented, the type of action that we've seen. But what does normal mean when you say, oh, we'll get back to normal? It's always evolving. So I think that's why, out of everyone I work with, when you say just trade what the market gives you and follow the momentum, you couldn't be more right with that.
Absolutely. Amen to that. I agree with you. All right. Well, that's it. We'll wrap it up, Jill, because I know you got to go in a couple minutes.
Great.
Party to go to. Thank you so much for joining with us today. I really appreciate it.
Of course. Yeah. I'd love to. I would love to join whenever you guys would like to have me on. It's always great to be back with you.
Probably have you back on at the beginning of the year. What do you think?
Awesome. Done.
All right. Well, have a great night tonight. Have fun tonight, and
me too.
Let's go Kings tonight, because I'm going over opening night to go watch them play open against the Flyers tonight. So.
Cool.
Big Kings fan. Love the hockey. So anyway, thanks again, Jill. Appreciate you being with us, and everybody else. Thank you very much for joining in with us. And if you're in the chat room tomorrow, let's go ahead and let's rock it up tomorrow. And I'll see you guys tomorrow afternoon. And don't forget to don't miss next week's webinar with Brian Gilmartin. Brian's coming on to give us a little bit more of a preview, a little bit more than what Jill gave us in terms of ideas and stuff like that for earnings season for Q3. Anyway, thanks again, Jill.
Thank you.
All right.
Have a good night, guys.
Have a good one, Jill. Thank you. And thank you, everybody. And I'll have the webinar replay up in a little bit just after the close. Take care, everyone. Have a great night, and I'll talk with you guys soon. Bye-bye.